over time, these things kind of differentiate. Kind of like how there was a while, I remember back in, say, 2021, people would compare Bitcoin to ARK, the popular ETF, and they, they'd be very correlated. But when you fast forward a long enough time, fundamentals mattered. ARK had that more stagnationary period where Bitcoin went on to, it had a bear market, but then it went on to higher highs ultimately.
If you found this helpful, please like, subscribe, and turn on notifications for more insights into the digital asset space. Your support boosts the algorithm and helps this channel grow immensely. Drop your thoughts in the comments below. Thanks for watching and enjoy the rest of the video. One of the first things Lyn addresses is something that's puzzled a lot of investors for a while now. Why has Bitcoin traded so closely with software stocks? Her answer is clear and measured. For much of the past few years, both on multi-year and multi-month timeframes, Bitcoin and high-growth software names have been highly correlated. Whether it was humans or algorithms doing the grouping, the market essentially lumped these two very different asset classes together, treating them both as risk-on, speculative growth. But here's where it gets interesting. Lyn points out that in recent weeks, at the time of this conversation, there's been a notable break in that correlation. Bitcoin has moved significantly higher, while many software names have remained flat or declined. She's careful not to over-index on a few weeks of data, but she sees it as an early and meaningful signal. Her historical analogy is illuminating. She draws a parallel to 2021, when Bitcoin and Cathie Wood's ARK Innovation ETF were often compared and moved together. But fast forward a few years and fundamentals diverged dramatically. ARK stagnated while Bitcoin went on to new all-time highs after its bear market cycle. The reason, in her view, is simple. AI disrupts software. It does not disrupt Bitcoin. If AI makes it easier to recreate software tools, reduces the number of seats companies need to buy, compresses pricing power, and lowers barriers to entry, all of that chips away at software companies' moats. But none of those forces fundamentally alter what Bitcoin is or what it does. It remains decentralized, permissionless, and scarce. The correlation was a trading artifact. The fundamentals were always different, and Lyn believes the market will, over time, reflect that distinction.
The short answer, so it has been highly correlated to especially that software side. I think that either humans or algorithms were kind of lumping it in together, both on a multi-year time frame, even on a multi-month time frame. There was an odd degree of correlation there. I would point out that very recently, like in the past a couple weeks, there has been a pretty substantial break where Bitcoin has gotten quite a bid, whereas a lot of the softer software names are still kind of in the trenches. We'll see if that holds. It might be too early to say, but I do think that over time these things kind of differentiate. Kind of like how there was a while, I remember back in, say, 2021, people would compare Bitcoin to ARK, the popular ETF. And they, they'd be very correlated. But when you fast forward a long enough time, fundamentals mattered. ARK had that more stagnationary period where Bitcoin went on to, it had a bear market, but then it went on to higher highs ultimately. And I think the same thing will happen where ultimately fundamentals will matter. Software will get disrupted to varying degrees. And Bitcoin will either get disrupted similarly or it won't. My view is that the types of the fact that AI comes along and makes software less necessary, fewer people need to use it, affects their pricing power, makes it easier to recreate around the margin, does slow them down eventually. But I don't really view it as a particularly fundamental impact on Bitcoin other than a trading comparison. So I do think that they will decouple, and in recent weeks have already kind of showed early signs of doing so. So for that, we do Bitcoin and stablecoin stuff. We stay out of the broader altcoin space. And it's mostly things that are trying to bring utility to these things, either to make payments easier, to make it easier to buy and sell Bitcoin, to do kind of neo-banking type of stuff with stable coins, and those areas. We kind of stay out of that broader speculative area where possible.
What is the overlap between Bitcoin and stablecoins and AI?
Mainly that they are money, and they're permissionless money for the most part. Stablecoins less so because, of course, they're centralized and they can be frozen and sanctioned and all that. But for most, it's more of with a bank account, it requires action to get a bank account. Whereas, say, with stablecoins, it takes an action on their part to shut off your access. By default, you have access to these open protocols. with Bitcoin being even more open. And so, there's increasing kind of interest when you have autonomous agents for them to have autonomous wallets. It's obviously hard to get AI to sign up for a bank account, but it's not that hard to give it access to stablecoins or Bitcoin Lightning and all that. A lot of Bitcoiners were kind of interested in that AIs were going to pick Bitcoin as the best money. I think it's more complicated than that because they're going to also optimize for near-term volatility reduction. A lot of AI agents aren't storing their money for 10 years. They're storing it as working capital to do tasks that they're expected to do. And so basically stablecoins are the money that if they're not in a sanctioned area, if they're not worried about getting their funds frozen, and they're holding, a month or so of working capital to do their activities, that's probably what they're going to be interested in using. And then, if it turns out an agent wants longer term capital, Bitcoin is of interest, or if it's doing something where it's in an area that it is at a higher risk of being, frozen or sanctioned in some way, it wants that more decentralized money in exchange for the higher volatility. That's an option. And I think over time, we'll see more bank products coming to market to try to give AI just more integration into even the traditional banking system, because I don't think they want to be left behind entirely either. So I've been moderately bullish on stablecoins, and I continue to be. For reference, I became bullish on them publicly in January of 2021. It was something like 30 or 40 billion in market cap. They've something almost 10x from there. I don't think we hit $1 trillion in a year. So in your spectrum there, I don't think we hit $1 trillion in a year or two. 5 years, certainly possible to hit $1 trillion in market cap. That really wouldn't be that big of a multiple compared to what we did in the past 5 years. So I think we'll have slowing but still substantial growth ahead. Going much higher than that starts, I think, to run into frictions. I don't think the stablecoins just disintermediate everything, because as they grow, they increase. Obviously they're especially of interest outside of the U.S., where it's harder to get dollars in bank account access. They basically take the concept of an offshore bank account and they compress the overhead tech to anyone with a smartphone. And so I do think there's a lot of demand for that, both for kind of near-term savings and for payments, especially small businesses that are kind of operating cross-border anyway, let alone individuals that just want to save in kind of inflationary areas. So I think we do hit $1 trillion, but not super quickly. So it's moderately bull. And then, I don't really view Visa and MasterCard as highly prone to disruption in the near term. One thing is that in the traditional finance space, reversible transactions are a feature. They want, like, a lot of consumers want to be able to reverse transactions. A lot of institutions want to be able to provide reversible transactions, fraud protection, various things like that. And I think stablecoins have their place. But they more complement those types of services. Now, the further you look out, if we're talking years and years and years in the future, then maybe we do see a more wholesale transformation of how this works. But on an investable time horizon of, call it 5+ years, I'm still pretty constructive on Visa and MasterCard, at least when they dip to their lower end of their valuation spectrum. Sometimes they do get a little bit heated. But for example, I think the recent sell-off in Visa was interesting. I'm tactically bullish here and there. I've not captured as much as I would have wanted to. There's some stocks that I just rode for 5-10 years. These are ones I tend to get in and out of a little bit too rapidly. But I've been structurally kind of bullish on a lot of them, whether it's the semiconductor, like the ones that make the manufacturing equipment for the semiconductor producers, or the semiconductor producers themselves. I've been bullish, and I think that it still has legs to it. I get concerned when they go vertical for this many days in a row.
Yes.
But for example, I don't think we're at the top all time of these RAM companies, for example. And really, I think value accumulates where there's either bottlenecks or network effects. And so if you go back to the prior decade, now they're called hyperscalers, but before they were, before the age of AI, they were largely just internet companies. The reason they were able to capture so much value is because they had these network effects, like social media companies and search engines and all that. And that makes it so that with a fairly small amount of CapEx, they could retain market share pretty well, and there wasn't really a lot of switching costs or a lot of competition once they kind of reach escape velocity. And so a lot of that could just be plowed back into share repurchases, much lesser extent dividends, and in Apple's case, for example, even borrowing quite a bit and then plowing that back into their share repurchases. And so you got these kind of multiple multi-trillion-dollar companies. I think it's going to be there's more headwinds on accumulating so much value in some of these really big, say either the AI model companies or even the hyperscalers going forward, because now they're so CapEx hungry. And there's like lower switching costs, when one AI ecosystem or tool starts to kind of stagnate, another one catches up and surpasses it, the switching costs are lower, unlike the 2010s kind of social media companies. So I think that less value accumulates there. More value accumulates in the users, basically the businesses or the consumers that are being more productive because of this. And of course, there are big winners along the way, but I think not at the same scale. Semiconductors, I think, the reason I think the investment community has been correct to be fairly bullish on them, occasionally, overdone at times, is because there are bottlenecks there. It's not easy to make new foundries. There's only three major memory companies that control over 90% of the market, for example. There's only a handful of GPU companies, with NVIDIA by far the most important one. And so it's that picks and shovels way to play, but one where you can't just get flooded with new entrants very easily. And so I think that has been, in terms of, since there's kind of weak network effects, it's those physical bottlenecks that are important in this cycle, and that includes a lot of the semis.
Following naturally from the stablecoin discussion, Lyn addresses one of the most frequently asked questions in fintech investing: are Visa and MasterCard disruption proof? Her answer, with nuance, is largely yes, at least in the near to medium term. The key insight is the one she already touched on. Reversibility is a feature. Consumers want chargebacks, merchants want fraud protection, institutions want dispute resolution. These are not legacy inefficiencies waiting to be disrupted. They are valued services that stablecoins in their current form cannot replicate. On longer time horizons, we're talking a decade or more. A wholesale transformation of payments infrastructure is possible. But for a 5+ year investment horizon, Lyn remains constructive on both companies, particularly when they pull back to the lower end of their historical valuation ranges. She describes the recent Visa sell-off as tactically interesting, and notes that these are the kind of names she has a history of getting into and out of, perhaps a bit too quickly, a candid and self-aware admission.
I think they're going to be somewhat more cyclical. I don't think they'll be as bullish as they were before. I think the market increasingly realizes that this is real, so they're not necessarily majorly worried about massive CapEx that doesn't pay off at all. I think it's more about a lot of these companies went from, some of the highest return on investment capital there is, basically very little CapEx relative to their size, could plow virtually everything in like I said, share purchases and dividends. And going forward, even if this investment pays for itself, it just doesn't necessarily have the margins that these companies did in the 2010s that got them so big in the first place. It's not really like almost like a magic money printer that they had. And so just in a more baseline scenario, neither a bear case, so you're not saying that these investments aren't going to pay off, but nor in like a hyper bull case. I think a more base case is that these companies obviously are very large. They remain very large. They probably will find a way to make a decent profit from what they're doing, but the overall switching costs are just much lower between their kind of, their data center build outs than it is between their social ecosystems, for example, and way more expensive in that arms race. And so I think the overall return on invested capital will be lower. And the market, I think, is rightly spooked about that. I don't think it's overly bearish. I don't think it's euphorically bullish anymore. I think it's become more right-sized and more company differentiated. I mean, it's not that long ago that people were very bearish on Google getting disrupted from AI, and then very quickly Google became an AI darling. So I think it'll become down to how well each one is doing, rather than just a general trend of kind of either buy them on CapEx announcements or sell them on CapEx announcements. I'm agnostic. My tools keep changing over time. I mean, my earliest focus on it was the AI art generation. Then it was the chatbots. Now it's obviously increasing the agents. Anthropic, has obviously taken a lot of the attention lately. I mean, that's I think where the best innovations come from. But now they're compute constrained. And so I over time I rotate to whatever models are working best. But I'm also not the one that's like every week changing a new model. There are people who almost professionally, their job is to play with these things constantly. I like to see them kind of get a little foothold, start to catch on, and then because I work for a living and other things, so I can only put so much of my attention into AI. In addition, I mean, because I work in venture capital, I mean, it compared to 2, 3 years ago, one of our really big kind of focuses is every time we make an investment or we increase an investment or we're helping companies troubleshoot an issue, AI is always a topic in discussion. What tools are they using? And things like that. We even get some of our companies to kind of share what they're doing with other companies so that ideally no one's really left behind, at least in the companies that we're involved with, to try to share the information because, like I said, it moves so quickly that one company might be super on top of it and another company might be struggling. And so we kind of make sure that that information is shared where possible and realistic. Yeah, that basically depends on the type. So some of them, that they're going to have a harder time selling as many seats as they did before, and or they have to lower pricing to retain those seats. Now, because I'm a value investor at heart, some of them, when they get cheap enough, they can get me on the long side. One thing I kind of differentiate among the software companies is there are some that are more prone to kind of the Jevons paradox than others, which is that let's say we make design services way cheaper, more abundant by a factor of 5x or 10x. If we just lower the hurdles, more people know how to do it because you can prompt it. The cost of doing so is lower. It might be the case that there's way more people want to design stuff. And so the overall market for design, despite being kind of lower per person, still becomes very big. Whereas, for example, software that does your taxes, for example, well, we don't really want taxes to, get way more, larger, right? There's a limit to how much ideally less. And so if you do cut the cost dramatically per person, you don't necessarily expand the number of people that are doing it or want to do it or the amount of kind of stuff being done there. So I think that's one test you want to do to any software company they might be looking at from the long side. But really then it comes down to just so far, like if you look at Adobe, for example, I mean, there's really real concerns around their disruption. It hasn't really showed up in the numbers yet. There's quarter after quarter, they're still growing top line, bottom line, announcing big share purchases. They have an AI tool that shows really good quarter over quarter growth. But the investors are saying, well, okay, it might be going well for a handful of quarters, a handful of years, but they're looking a few years out. And so I think there will be a clearing price for a number of these software companies from a value perspective. I do. I mean, as AI gets better over time, right? When for example, AI art generation was terrible, it was hard to use, and then it became really good, and then it extended into videos and all that, let alone writing code, let alone editing, let alone everything else that you can use it for. The more things it can do for you, the bigger percentage of someone's day can be allocated to having AI do stuff for them or overseeing AI agents, with fewer, like less time spent on error correction and spotting hallucinations and all that, and people kind of integrate with that better. In addition, obviously it takes time for many businesses to adapt. Even if the technology moves rapidly, it still has to kind of human decisions still have to kind of gradually catch up with it over time. And so I think much like how, for example, during the rise of smartphones, each model would come out and let you do more for less. I mean, they say, okay, now we have double the amount of memory and double the storage and better cameras, and it's the same price because Moore's law, more or less. And so and that makes that it used to be that it was like a luxury good. And then the top end ones were luxury goods and there were cheaper ones. And then even the kind of the highest end ones are still pretty affordable. And I think AI models are going to go through something similar, which is that, that they will keep getting rapid efficiency gains. The overall amount of kind of GDP that goes into this will, I think, increase over time until it hits some ceiling. I think it's too early to say how high that ceiling is. It depends kind of how good they get over time. But I think efficiency is part of the assumption.
On semiconductors, Lyn's framework is rooted in one key concept: bottlenecks and physical constraints. The reason she has been, and continues to be, broadly bullish on semiconductors is because, unlike the software layer, the hardware layer is genuinely hard to replicate. Building a new foundry takes years and billions of dollars. There are only 3 major memory companies controlling over 90% of the market. There are only a handful of viable GPU companies, with NVIDIA standing apart from the rest. These are not network effects in the traditional software sense. They are physical bottlenecks, real-world constraints on supply that create pricing power and durable competitive advantages that new entrants cannot easily breach. That said, Lyn acknowledges that the semiconductor sector will be more cyclical going forward than it was in prior cycles. The market has largely accepted that AI capital expenditure is real and meaningful, reducing the extreme skepticism that once weighed on these names. But it has also started to grapple with the reality that the return profile of this AI build-out won't be as clean or margin-rich as the software-driven decade that preceded it. Her bottom line on semis: value accumulates at bottlenecks, and she sees those bottlenecks as durable, though she's appropriately cautious about chasing names when they go vertical.